Good evening everyone and welcome to Admiral Markets webinar. Today is 15th of January 2015 and I need to use this special opportunity today. Actually it looks like it was random, but I will use definitely a lot about EURUSD and dollar Swissie examples for this webinar. Fortunately enough, if you used your stop losses on today's or yesterday's trading, you wouldn't be stopped out for only 20 pips. I was stopped out for only 20 pips, and that is a good opportunity to show you how basically trading is doing versus gambling and investing. Today also Chris will be with me, and after our standard risk disclaimer, we are ready to proceed. Risk disclosure statement stating all possible risks associated with Forex market. By accepting this risk disclaimer, you're also proceeding further with us. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get the corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Admiral Markets UK takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author. It's me and Chris, and in no way it represents the actual suggestion for the trade. These are not MK's opinions, and the website in the video is not a .co.uk website, but a globalnews.com website. Forex is risky business, and this is a personal opinion only. This webinar is for informational and educational purposes only. So today's agenda: trading, gambling, investing. Okay, trading, gambling, and investing. In trading, guys, we have three basic risks. So first, we will start with trading. Those are market risk, event risk, and liquidity risk. It's a simple definition of risk if you are a retail trader and trader generally, and those three kind of risk determine basically what you should do with your entry position, stops, and targets. Market risk is usually risk with stop loss. It's usually risk with your technical tools. So market risk basically is giving you only the risk which you have the control of, that is using technical tools to determine whether the pair or market will go up and down, using trend lines, trying to analyze the market, putting entry prices correctly, stop losses, and targets. Then we have event risks such as ECB, NFP, SMB floor, those events which are very risky in its nature. And we have liquidity risk. That means the pending orders are rejected. We have gaps. Today, Swissie, you saw what happened today. There was a bit of lack of liquidity. So when event risk is high, and I will use today's example because today is a perfect example. When event risk is high, liquidity risk is always high, and that means that market risk is also going higher. Okay? So event risk is high, liquidity risk is high, and market risk also is going higher. So this is the snapshot of EURUSD, and we are talking now about market risk. EURUSD and dollar Swissie. So all Swiss correlated pairs had huge movement today because SMB dropped floor, so now Euro is unpegged to Swissie. So Swissie is unpegged to Euro finally, and SMB introduced negative deposit rates, which should basically detract investors from investing and holding Swiss during the year, okay, in the bank. Now, when we are talking about market risk, I will show you now one example, and you can see that my stop loss is basically filled 20 pips, so I didn't have any gap. I have heard that many traders today basically had a huge slippage, and I have taken a snapshot, and you can see this was my order which was executed on 5th of January 2015. I bought EURUSD at 20.15. My stop loss was executed at the right spot, so I didn't have any slippage. Okay, and basically what I heard is, so this is my snapshot. So I don't know how other brokers do, guys, but definitely with Admiral Markets, this is very, very. I love when this happens, and I'm really happy because I know that some traders use their stops on other brokers, but their stops went 500 pips below it. So the first price, which was filled, I have read a lot today, and I have really witnessed a lot of flaming today. And I know that other brokers had the stops executed at 500 pips to the downside. And you know, you cannot blame brokers for that, because liquidity providers are basically protecting themselves. The liquidity providers are protecting themselves, not brokers, with such violent moves. And these things are always unexpected. So when EURUSD floor broke today, I was stopped for only 20 pips. Only 20 pips. Okay? And that is a great thing really about Admiral Markets, that we didn't have any slippage with this. At this price, which I was recommending you to trade, and this is the only loss trade we had on weekly Forex recap. All other trades were winners. I will show you the results. Euro dollar, cable, Australian dollar, they were all great winners. The only loss is this one, EURUSD. But if you use the Admiral Markets, and if you traded how I told you to trade, with this stop loss, I didn't give you 90-95 stop loss just randomly. This is correct stop loss. You would only lose 20 or 15 pips. Okay? And yes, that is why I'm talking today about market risk. Market risk. This is market risk. Okay? And indeed, hats off to Admiral Markets for having enough liquidity. Definitely, Admiral Markets was this. You know how I need to say something. I can say I am more happy than I was at the start of this year. I got great winners during the start of this year, really compensating for some losses on euro dollar longs and so on. And really, the start of Junior was pretty much great on my account. And today, I'm more grateful that I lost this trade than I'm grateful for winning all those trades after the new year. Because this is the biggest win today. This was the biggest win today. If you were in EURUSD and you were trading with Admiral Markets, guys, 20 pip loss, as I suggested, that is nothing. Many brokers, we saw 500, 700, 1,000 pip drop. Many accounts have been lost today. Okay? So what can I say about this is that I'm really grateful, and this is also the win. To lose 20 pip while 1 minute tick chart showed 500 drop in the first minute, that is something that we are also lucky, really. So guys, now this is the time when you should really take trading seriously, and you should always listen to what me and Chris are saying about the market. Always use stop loss. No matter what you think, no matter, guys, what you guess, what your charts are showing you. You always need to use stop loss. how many times I mentioned, and Chris also, you can have a great series of winners, but there is only one day, 1 minute is enough to kill all of your trades. Look at Euro Swissy, dollar Swissy down there. Guys, if you open monthly chart, you can see that whole year of gain in dollar Swissy was killed instantly during this day. So imagine an investor who basically waited for dollar Swissy longs and was in a great profit, only to open his chart today and see that all of his gains during the whole year, that is 365 days, were lost, and he was stopped out, maybe for a margin call. Okay? That is what happens when you don't use your stop loss. That is market risk. That is risk which you can control. You can be a control of a market risk. Not using a stop loss. Think twice about it. If anyone, today one guy on my Forex Factory thread made a great statement, and I really liked it, and he wrote, and I really should stick this to every single time I'm having these educational webinars. If anyone is thinking of trading without stops, snapshot Euro Swissy and dollar Swissy chart and stick it on your desk. So when you look at these charts, now you will definitely think twice about trading without any stop loss. And really, I need to say hats off to Admiral Markets for having enough liquidity to save us from huge drop that happened today. Okay, from a huge drop and from a potential account loss. Okay, now those were market risks. You can control market risks, but you cannot control event risks. Today we had SMB event risk, and Swissy was unpegged from Euro. Now, what are the reasons for basically abandoning 1.20 floor on Euro Swissy? There were plenty of reasons, to be honest. First reason was definitely monthly lows on euro dollar. Okay, monthly lows on euro dollar. Now if you open euro dollar chart, let's see, I will open now euro dollar, and you open monthly chart, look at this, guys. This is basically, look at this is high, this is low. This is a lower high, this is lower low. Now this is again lower high, this is not the lower low, but it's still a low. This is definitely lower high, and this is definitely lower low. When this level was broken, I was mentioning a couple of times that this is crucial level 2040. When this level was broken, the only level which could have protected euro from further drops was 1875. Okay, that level was broken, making M 1 to 3 bearish reversal. Euro dollar monthly chart suggested that this pair, if it isn't bought into it by intervention or by SMB, because SMB was the major buyer on euro last couple of years, we wouldn't see euro dollar 23, 24, 28 levels. What happened is SMB tried to protect the floor and to protect euro dollar currency by buying pretty much billions of euros. But the thing is, we have also on the 22nd ECB meeting, and quantitative easing measures, which should be expected on 22nd of January will definitely bring euro lower. Okay? I'm not saying instantly. Maybe the whole euro drop is already priced in. Don't forget this. Maybe this ECB will maybe push a little euro to the upside, but I think that all this euro drop is priced in quantitative easing, but is definitely dragging euro lower. Then on the contrary, we will have Fed meeting when we expect dollar to go up because, and maybe it's already priced in because Fed will probably present us with rate hikes, which is hawkish for dollar currency. Okay? Now pay attention. Euro is lower, dollar is up. And definitely this is the truth. SMB doesn't want Switzerland to be trapped between those two forces any more than it has to be. So what they did, they dumped euro, and what I taught you all this time, every close of the long is automatic sell in the market. So each time a long position is closed, that is a sell into the market. Because if you want to close your long, your platform actually sells it. Okay? Billions of euros were closed and they gave up on protecting the floor. Euro dollar dropped 200 and more pips. Euro Swissy dropped 2,000, 3,000 pips. Dollar Swissy also 3,000, 4,000 pips. But look at the logic behind it. Okay, look at the logic behind it. They dumped euro and they erased complete year of gains. Look at this. This is 2011, guys. Look, complete year of gains was erased in a single monthly candle, in a single day. What they will do now, I presume, they will buy dollars in order to drag Swiss down. Look at the logic behind this event today. Euro dollar was done. They closed all their long positions, so they cannot protect the floor. Floor is bye-bye. It's gone. We don't think about any floor now. We don't have floor. But look at dollar Swissy. It was brought back pretty much down to the lows of 2001, 2011. And what they will do, they will intervene, not on Euro Swissy, not buying the euros, they will intervene buying the dollars in order to bring dollar Swissy up. When they buy dollars, Swiss will go down, but dollar Swissy will go up. And that is the good case, because if euro dollar goes down, dollar Swissy is still going up. So why would they protect euro dollar or buying euros when euro is constantly going down, when they can buy dollars, basically still lowering the strength on Swissy? And that happened today. That was the event risk. You cannot protect yourself from event risk. If you are intraday trade, not intraday, it doesn't matter. You could have been trading for a whole year just to see your gains erased in a single candle. Minute candle, guys. I'm not talking now about monthly candle. In a minute candle. So event risks are there. Event risks will always be here. It's up to you to use market risks to protect yourselves. Okay? You just cannot protect yourselves from these event risks, because you never know when those risks will kick in and what can happen. Liquidity risk is the third thing. Liquidity providers are protecting themselves, which is normal. You could have noticed today that there were spreads which were huge on Euro Swissy, Dollar Swissy. Spreads were about 600, 700, 1,000 pips. And this is not what brokers do. That is what liquidity providers do. They need to protect themselves. Okay? And that is why we were introduced to high spreads, abnormal spreads. MT4 platform is not designed for the moves like this. MT platform can handle, I don't know, 10 ticks per minute, 10 ticks per second, whatever, but 1,000 ticks in a minute, it cannot handle. That is the flaw of MetaTrader 4 platform. And when moves such this happen, many traders will see frozen platforms. They would not be able to open any positions. Broker will reject those trades, pending orders will be rejected, and gaps will be shown. That is called liquidity risk. When there is no liquidity, that means that brokers are closed, they're not quoting the price. And basically that is what now is happening to all Swissy trades. Most of the brokers are basically forbid trading on each Swissy pair until situation settles down. But that is of course due to liquidity. Okay? When there is no liquidity, okay, that means brokers are not giving us the price. And liquidity providers should protect themselves. Today most of the brokers basically try to close the orders at the exact price, but you know, when there is no enough liquidity, there will be slippage. Okay? Fortunately enough, Admiral Markets had enough liquidity to close our loss only for 20 pips, which is absolutely brilliant. Now, the thing is, don't forget this one. When event risk is high, liquidity risk is high, and market risk is also high. This is what we cannot be influenced. These events are there and they will exist. But that is why you need to follow the market, not just the chart. You need to always pay attention to what we are saying, where we put our stops, where we warn you, because some things are unexpected. Yes, Ahmed saying liquidity provider close liquidity. Yeah, non-admiral markets had enough liquidity partners to provide liquidity. That is good. That is correct, Ahmed. Liquidity providers close liquidity. And basically what happened is slippage, huge one. When we talk about gambling, that is again another thing which you should definitely avoid. I know that is what is pretty much interesting to you if you love to trade, and I know that many traders are simply enjoy the feel when they are putting one full lot on $1,000 account, but that is nothing more than gambling. Over leverage is also gamble in Forex market. It is so because when you open your position, you will base your open position to your stop loss. So if my stop loss is, I don't know, 20 pips, 30 pips, let's say I use 0.5 risk. I know I'm not saying that you cannot use 100 pips stop loss for 0.5, but usually the risk is lower. So you should always avoid over leverage. Remember, Forex is not poker. Poker is something, it's reading your opponent. I had a friend who basically was professional poker player, and he was pretty much successful. He told me that the biggest merit of a poker player is that he or she is able to read his or her opponents. You cannot read the market, forget it. Who would have thought that today EURUSD will drop 2,000 and dollar Swissy 3,000 pips, and many Swiss pairs? Who could have thought of that? Of course, President Jordan gave an explanation saying it's normal that these things are done in secret. I agree. It's normal, because if everyone knew that today they will drop floor, everyone would be billionaires, right? I would use all of my margin to go short into the floor. But my logic wasn't stupid. How can I short into the floor, which was introduced 4 years ago, and 1 month ago they swore they would protect the floor? Now, who would be crazy to go short when the price is 8 pips above the floor? At least not on EURUSD. I know that many traders were short on dollar Swissy, but not on EURUSD, definitely. Yeah, governor's wife, maybe. Those things, you know, you never know. Maybe governor's wife or his best friend, godfather, I don't know. Maybe no one. I won't insinuate, I don't insinuate, I'm not saying, but the thing is, he was definitely right. Those things are done in secret. Okay, maybe he told someone, I don't know, I don't want to know about that. It's not interesting to me. Who will be billionaire by, I don't know, selling EURUSD on the floor? Well done. If someone did that, well done. If someone had that insider information, well done. Great. But that's not trading. It's still gambling. It's still gambling. Okay? Remember about George Soros. What he did and how he made himself a billionaire. Okay, he gambled. He had that inside information. I'm not saying it's okay. You can use whatever means you want. You cannot blame someone to short EURUSD on 2008 price. If someone did that, he was definitely gambling, with or without insider information. You can do that in Forex market. You can gamble in Forex market. But that is over leverage without stop loss. That means long 1.20 on euro dollar, put 3 lots there and forget about stops. And maybe in a half year you will be in a profit. But until then you will be sweating and praying that the price reverses, because you are actually gambling. Occasional gamblers, they do not have a plan or strategy. Occasional gamblers basically are paying the house to play. They do not know what to do. Even poker players, occasional poker players, they just are throwing their cards without reading their opponent, without trying to read signals, without feeling the players. Occasional gamblers are just gambling, and they're paying the house to play. Novice traders start trading the Forex market without ever having developed a well thought out trading plan. And that is also the truth. What me and Chris were saying when we were talking about having a plan, if you develop a plan, that will be your first step to a success. But if you don't have any plan, then gamble, guys. Then gamble and see what you will get out of that gambling. Trading based only on buy low and sell high is also gambling. If I saw today that euro dollar went to 1.6075, I could have said, great, that is the level to go up. But we need to use technical tools to see whether that level will provide support enough for euro dollar to go up. If there is no support on that level, we are gambling again, because we have gut feeling that the price will go up, but we are not using technical tools. Okay? Okay? And yes, Anis, saying gambling Forex is the costliest education you can have. Definitely, guys. It's better to visit our webinars than to gamble on Forex market. This is free and this will save your money. And look at the post taken from Forex Street. If you're in pain, at least know that Goldman Sachs is with you. there is a big fund, trading fund, and Goldman Sachs is doing with big money. And the article says a lot of people heard today, including Forex analysts at Goldman Sachs, who say they're closing a short Swiss SEC top trade for 16.5% of a loss. It was down somewhere between 1,000 and 2,000 pips, depend on the stops. These are generally model portfolios, and Goldman is unlikely to actually hold it as position. Now, I have retweeted this on Twitter, and I made a headline saying, is this gambling or trading? How you can trade 2,000 pips without stop loss? How you can lose 16.5% big money in a single day if you use your stop loss? Okay? Maybe they use retail client money, I don't know, but they lost 16%. The only answer is investing, guys. Investing is the only answer. You remember when I was telling you about building account versus investing account. Let's say you use building account. So you use $10,000, and maybe in a couple of years, if you're trading, not gambling, you will have, I don't know, $50,000 on your account. Now that means that you have been building the account. $10,000 to $50,000, or I don't know, $10,000 to $15,000 or $20,000. So you are basically building the account. You are building the account to actually later maybe invest in that account. You are building account effectively when you are trading it each day, or I don't know, 3 times per week. So you are building the account. You are scalping, you are using intraday positions. You want your account to grow. That is when you build account. When that account is fully grown, then you will start to invest. That means you will open one position, let's say EURUSD, on 1.2030, and you will hold this position all the way until it makes 10% of a profit. For example, that means you don't use your stop loss because you are effectively investing. So let's say that you don't trade, I know, $50 account as investment. If you are a retail trader, you can use this account, $50,000, to actually put one trade and wait full year to develop. But they are working with big money. They are working with millions. And when they open a position, that's not leverage position. So they are basically investing. I am always against, even when investing, not using a stop loss. I am always recommending using your stop loss even when you are investing. When you are investing, you are not using classical stop loss. I know, stop loss 100 pips below monthly low. We don't use that kind of stops. When you want to invest, you're using fixed stop. When your account is, let's say, 3% or 5% in a loss, that is when you close your account. That's called fixed stop loss, using percentage. So it can be called fixed stop loss, and it also can be called percentage loss. If you remember a webinar me and Chris did with Admiral Markets, that was basically the webinar about different kinds of stop losses. They should have used percentage stop. When the account was 5% in a loss, close the account, close the trade. But they let themselves lose 17% almost. So investing is done with no leverage and with no stop loss. But that is why you use percentage stop loss, not swing high, swing low. And what when day like this happens? What then? What then? Then you should cry, definitely, because this was the price of, look at this date here. The price, the candle was 1st of September 2011. Some people lost their 3-year investment only in a single minute. Okay? Only in a single minute. Conclusion of this, and I will handle webinar to Chris. Use low risk per trade. Use your stop loss. Accept losers. Even if you lose, you're in the control of the situation. You will lose that much which you are able to handle. And no gambling, please. You cannot read the market as poker players read each other. Remember this. Only a single day is enough to wipe you from the Forex world and from the world of investors. Thank you for listening to me. I will handle the presentation now to Chris. If you have any further questions, do not hesitate to ask us. Chris, you can continue.
Awesome explanations here of what happened in the market today. Crazy moves, of course. Let me start my screen sharing here. So today's action here created by the Swiss National Bank, quite an introductory, a very nice introduction to our topic, in fact. It almost would seem that Ned and I coordinated with the Swiss Bank to have that fall before our webinar, but that's not the case. We don't have that good connections there. So it's just coincidence. But it is a crazy move. For some, unfortunately, not good news. For the lucky few, maybe a bit good news. If some maybe perhaps making some money, but I wouldn't expect many to do that. Well, basically, I don't want to go into the Swiss franc side of things all too much. I mean, Nena did a great job of explaining the whole dynamics, which was very interesting, and all the angles to that. I think just in general, the view on looking at trading and gambling and investing highly also depends on where you're at this moment and what, let's say, how do you view the markets, the financial markets, what is your bias towards that? How do you see these developments? Do you know anything about it? Do you follow it? What kind of interest do you have? Basically, of course, you have people who are traders themselves and non-traders. There's already a very big difference between those two. A lot of non-traders don't have much feeling for the markets. They don't understand the discipline that traders try to hopefully show and implement. So for them, it's very easy to kind of group trading and gambling as one and the same, right? That is a very easy association to make for them. So it's going to be highly dependent on who you're going to ask and what kind of background they have. If you're asking a trader, they're going to see the difference. It will probably be, they're going to be a bit insulted, perhaps, right? If you're going to ask someone who's maybe a farmer and is far away from the financial markets, that person might see traders as gamblers quite quickly or quicker at least. So that's one, of course, background. Your view, your bias will have definitely a very high impact on that answer. And I'm not saying that one answer is necessarily right. Obviously, I have my own opinion on that, and I don't see that as I don't see that the same as gambling, logically speaking. But I do realize that the answer will be highly dependent on where you're coming from and what you've experienced in life and what you're doing as occupation now, and that has all its impact. Now, the biggest critique points that gamblers are going to have is the fact that you can't have an edge, otherwise everyone is a millionaire. But this is, of course, a bogus nonsense, because just because you have an edge doesn't mean that the edge is going to lead to millions. The edge could also lead to smaller profits. No one says that an edge is infinite, never-ending. An edge could be small. An edge could lead to break-even, or maybe that's not an edge actually, but an edge could lead to a small profit. An edge could lead to a very big profit, and that also will fluctuate from year to year. Variance is very strong in trading financial markets. 1 year, 1 month, 1 week, 1 day will never really be the same. right? And we Forex traders know that. No, an edge is never the same. It's not like an edge will be always tremendous. So that is a critique point that I highly disagree with, right? That is not a reason why Forex, why trading as in general and gambling would be similar. No, that is not a valid point, no matter what your opinion on the matter is. The second is something different, cannot predict the future. Okay, fine. Although here too, really not really a valid critique point because of the fact that trading is not about predicting the future. It is about finding an edge and playing that out time in, and time out with discipline and consistency. All right? So we're not in the predicting the future business. And if you are, that's for maybe fine for fun, but it really has nothing to do with trading. So the critique points that often are used are invalid. And that is where the if there are other reasons, you know, I don't know exactly. It's for instance, a trader, a non-trader could say, well, it's difficult to find an edge. That's a different story. It's not easy indeed, and that's something that, you know, would be a different story. All right. Let's move over. Let's take a look at the differences. A gambler is basically an uncontrolled risk taker, and a trader is approaching his business professionally. A gambler is looking for the quick fix, the quick dollar. High excitement, a lot of adrenaline, is taking that risk despite the fact that the odds are against them, and is only focused on winnings. Now if we compare that to the trader, right, we're looking at profits, take time. It's a long-term activity, a long-term business model. It's almost to a point where it gets boring, repetitive, right? That's when we know we're on the right track, in fact, when it gets to that stage. We have the edge, although maybe slight edge, but we do have it. All right, and we're focused on risk, right? Whatever risk, the various types of risk that there are. And then it gave a great explanation about market risk with the Swiss franc today. So these are important differences, important differentials here between a gambler and a trader. All right? Very important differences. A gambler, to just elaborate a bit more, goes through an emotional roller coaster. And I'm not saying that traders don't have those emotions, because it is money on the line, right? If you would probably play chess with money on the line, it would also be a bit more emotional. If you would play tennis for money, it would get more emotional. That doesn't mean that tennis is gambling, right? So just because there's an emotional roller coaster, it doesn't necessarily mean that. But gamblers do have that very strongly, though. Very, very strongly, that element, right? And they're not looking really at implementing a consistent plan or an edge. They just hope to get a payoff in a random event. The trader there, in fact, is having a clear, concise plan with a focus on risk management and understanding probabilities and where their edge lies. So they're focusing on those two things. Where is their probability edge and where is risk management? And they have a plan to tackle that. And they have the ability, and this is important because having a plan is one thing, but they also have the ability to implement and follow that plan. So it's demanding to get to that trader stage, but these are the important things. And trading in itself has nothing to do with gambling. Trading is an old profession. There were traders thousands of years ago taking goods, going to the market, selling it at the market. The only thing is that the characteristics have changed. I don't go to the market anymore. I'm sitting behind my computer. I'm not exchanging apples anymore, but we're exchanging money. But do you consider an apple trader a gambler? No. It's a business, right? So that is the main difference between these two. One second, let me continue here. A gambler basically doesn't know that there are even odds or doesn't have those odds in their favor, doesn't even think about those odds. A trader is very consciously focused on those odds, always optimizing those odds, trying to find the best odds, trying to look for the best probabilities, I should say. Probability is a bit better word than odds, actually. Odds is more connected to gambling, right? So always looking for that long-term edge. And we're trying to manage that, all right? Now, will those traders succeed in that? And that is, unfortunately, not true. Not all traders will manage to get those good probabilities for various reasons. All right, so just because some traders don't achieve those probabilities doesn't mean that they're not professional traders, in my opinion. All right, or at least they're not treating trading as professionally. They're treating trading professionally. Maybe they're not the pro trader yet, as you kind of think of it, but at least they're treating trading professionally, even though, let's say, that they're losing. It's the same like a tennis player that hasn't reached the high ranks of the World Tour yet. The number 500 or number 1,000 tennis player is still treating tennis in a very professional manner, although he's not in the top ranks as yet. All right, there's something else I wanted to add. Let's see. I seem to have lost that slide. Apologies. I'm not sure. I'm just looking for a slide that I thought would be now. But it doesn't look like I have it anymore. I don't know. I must have deleted by accident the slide. But anyhow, I remember what I wanted to say in that slide, so I'll just tell you. Is the fact that basically you could even have poker players, right? They can have an edge too. If you are a good poker player and you apply a strategy and money management, you can have a long-term edge too, right? Although I think that in poker, the long-term, it's a bit of a more longer-term approach you need, in my opinion. Now, that is a professional gambler. So basically, you can have the following matrix. You have pros and you have amateurs. And then you have on the top here, you have trading and gambling. Okay? You can have professional traders, right? Absolutely. But you can have amateur traders. They're treating trading as gambling. Right? You can also have amateur gamblers that just go there and throw some money on the table without any plan. But you also have professional gamblers that treat poker as a profession and have an edge in the long term. So it's all about basically the professionalism and how you approach it. I read a book about a guy who makes a ton of money with sports betting on basketball games. He has a consistent edge in basketball games. All right? He wins about 55% of his bets or something like that. But it's enough to make a lot of dough. So the whole idea basically here is about the professional approach. Although I do think that there's a difference between poker and trading and sports betting trading. In general, though, the approach is the main criteria. That's the slide I wanted, and I lost somehow, unfortunately. Investing is about slow and steady. And I agree with Nenad, by the way, from the first thing I want to say, by the way, because I didn't mention it here, and before I forget it, I want to say it, is that I agree with Nenad that investing is good to have a stop loss as well. Now, of course, we're talking about stocks, right? I think it's good. Now, not in terms of pips, indeed, but let's say a 15% of the stock or something like that. I think it's good that you don't go into this bottomless pit of losses in one particular stock. I think it is a good idea, and I agree with Nenad on that. Investing, of course, is different. It's a slower and steadier, lower frequency of trades, therefore less transaction costs, also reduces the barrier of profitability, but of course the transaction costs in stocks are often higher, much higher than in Forex trading. But you do trade less. Risk management, vital too. There's less time-related issues. The timing of things is a bit less important. Forex is very important, especially with higher leverages or normal leverages. We got dividends payouts, basically, right? That's investing. Now, the buy and hold strategy is very passive. And if you have a very poor timing, it can take decades before you're into profits. If you invested in the peak of 2000s and you didn't exit before that crash, you had to wait a while before you were back into profit. Right? So buy and hold strategy was very dominant strategy ever since the 50s, 60s, 70s, 80s, 90s, but has become less popular. And how do I know that? Because if you look at the average holding time periods, the 50s, a stock was held 6 years. In the 2010s, 10 times less, 6 months. So the dynamics have certainly changed. The investors are not buying into the buy and hold strategy, and I think that makes sense. First of all, I don't think it is, in these dynamics, in this time of the day, not a good moment to do that, first of all, at this point. Also, the question is how long it will take, indeed, before the general question maybe if the buy and hold strategy is good at all, because it doesn't take too much of timing into account, and if you really want to get some decent profit, timing is still decently important, maybe not as much as Forex, but still. So I do think that the buy and hold is not a good one, right? So it's not surprising that we see this decrease. So with the investment time going down from 6 years to 6 months, are we all now traders? Are investors really, do they still exist, in fact, right? Or are we just all traders now at the moment? Well, difficult to say. I mean, we have obviously active short-term trading, intraday trading, intra-week trading. Long-term trading, perhaps if you're talking about weeks and months, it could be already kind of a mix with investing, and you have the passive long-term trading. Now, where you put the exact border is difficult to say. In Forex trading, I would say if you use leverage, it's trading. If you don't use leverage, it's investing. Let's say you just change your own money and you exchange euros for Australian dollar when it reached 150 or so. Well, I think that's not trading. I think that's probably investing. And you buy some Australian stocks, for instance. You get the difference in interest rate, and you pick up maybe perhaps some stock gain if you're lucky, or at least some dividends, and perhaps even the currency difference, right? If it drops, like the EURUSD is doing. If you don't use leverage, it's investing, I think. If you use leverage, you're trading, and then you probably wouldn't buy stocks. Long-term trading, I think, is about days and weeks. Long-term investing, probably months and years. But the difference, I think, is becoming less, if you see what I mean. The leverage is probably the biggest differential, but the time factor is becoming less. All right? So we got a question from Usman. Let's take a look here. Can you show me the slide, non-traders seem traders as gamblers? I want to take a snapshot. Let's see. Here, I think this one, right? Wants to take a screenshot, maybe to show it to someone. Let me know if this is the one. So are there any questions out there? I mean, on Nenad's part about the Swiss franc intervention and the risk event, or perhaps this more theoretical part about trading, non-trading, trading, gambling, and investing. Any questions perhaps out there? So to summarize, trading, it's all about the approach, right? Non-traders could be gamblers. Sports bettors could be professionals. It's about the approach and the difference in the attitude. Once again, these differences here: professional versus uncontrolled risk taker, having an edge, focusing on risk, understanding the long-term variance. And that's something I think that is one of the biggest things. That's why we talked about a webinar, the drawdown webinar last week. And I think it's so important because I don't think many traders realize what kind of ups and downs you need to be able to survive before you really get to long-term profitability. Many traders just scream that, just don't really see that point. They run for the hills when the strategy of theirs is down 2% in 1 month and think that whatever they're doing is nonsense, or whatever they perhaps purchased is a scam, or whatever they created is invaluable, or anything of that. And it's total, pure nonsense. The biggest nonsense you can ever have. If you look at Warren Buffett, one of the best investors out there, and look at his variance, what he made in profits, when he made it, it's so concentrated in such a short time frame. And it's also not to say that he didn't have losses, right? Not on the contrary, he certainly did. That's what risk is all about. But it's about, that's why you take risk, because you're going to, you want to make profit, but you're never going to make always the right decisions. So it's about this consistency and discipline and risk management. All right. Well, next week we always have, of course, the same lineup. We got Toronto taking a look at the recap on Monday for the next week, and Wednesday expert opinion, and then we got live trading webinar on Tuesday and Wednesday. So that schedule is the same. I don't see any questions, so be cautious with the Swiss francs in the upcoming days. Let it settle. Let's see what happens. Take a look. If you take any trades, be careful. I don't know. Maybe perhaps depending on which broker you have, but perhaps there could be some different margin requirements. You never know. It's a whole new ball game, and I guess there would be some time needed to let things settle. It's like a big wave hit the boat, and the boat is still rocking quite a lot. So be careful, and thanks for joining. And wish you all good trading, and see you next week. Cheers.
Cheers, everyone.